Don Luskin of Trend Macro. We have Joe Livornia of Deutsche Bank's head economist there. We have Kudlow & Company contributor Jerry Bowyer of Benchmark Financial Network. Herb Greenberg, CNBC contributor and senior columnist, Market Watch. And Jack Gage, associate editor, Forbes magazine. Welcome, everybody. Don Luskin, what does this mean exactly? Yep. The dollar had its best day against the euro since 2004, according to some circles. Gold continues to tank. Oil is beginning to follow gold, and stocks seem to love it, Don. Can you make sense of this big picture and a little changing scenario?
Yeah, this is easy, Larry. It all goes back to March 17th, Bear Stearns Monday. That's when the world changed. That's when the Fed figured out that it can solve the credit crisis by something other than cutting the funds rate. And so ever since then, all of these different markets that you've mentioned have gradually come more and more to realize that it's one and done at this point at the most, and that the Fed is going to start hiking again as soon as October. The futures markets are now looking at 3 rate hikes from out a year from now. So that strengthens the dollar, it weakens gold, it weakens oil. It's great for stocks because it means that the Fed is going to stop fueling the inflation machine and that there's confidence that the credit crisis has been mastered. This is just fantastic news. And by the way, you didn't need to read about this in Greg Ip's column in the Wall Street Journal today. All you had to do is listen to this show for the last 5 weeks.
Yes, you're very kind, and I appreciate that. What's so interesting, Jack, among the many things that Don Luskin touched upon a moment ago, is that stocks are responding to this, we'll say tighter money therapy, or let's say even keel money, moving away from ease. Dougie Cass, who is a great friend of the show and a terribly smart guy, but he told me last night, if the Fed behaved this way, if commodities start to tumble as gold is tumbling, as oil is tumbling, and I think oil is going to follow gold down if this end of Fed easing scenario stays. It's interesting to me how stocks have done very well. Stocks are adapting and adjusting to this and seem to say, on balance, we don't need an easy money Fed, Jack Gage.
Absolutely. Well, you know, it does go back to the old analogy. Think about a vending machine. You put some money in, it doesn't come out, you don't get your soda. Instead of kicking it and yelling and screaming, put a couple more cents in. And look, we've stabilized the market here. Enough with the frustration, enough with the would-be recession. Starting to look like Ben Bernanke's ready to walk the walk instead of just talk the talk on a stronger dollar. And if that's the case, we can expect this rebound to continue.
Now, Herb Greenberg, it is wonderful to see you amidst all this optimism that we are all sharing with each other, and I'm quite certain you can throw a cold blanket over it. But I want to ask you about, this is very important, Jim Kennedy, the CEO of T. Rowe Price, a stock that, by the way, is up 11% today. Mr. Kennedy says credit pressures are easing. There are no longer any particular strains. We are not looking into the abyss. We have some charts that show, I think, the junk bond spread against treasuries has narrowed 150 basis points. And incidentally, long-term and short-term treasury rate, look at that junk spread, has come way down, way down. That's a sign of improvement in risk-taking. And also, treasury rates are rising. That means, again, people are moving from risk aversion back into the economy. All this is good sign, Herb. What do you make of it? Are you ready to make the call here? This is it? We're okay? The credit crunch is over, and it's time to buy stocks on the bet that the economy is going to be stronger?
Jim Kennedy is interpreting the numbers the way he's interpreting the numbers. Maybe he'll be right, maybe he'll be wrong. Larry, what we know is, look, we're on the roller coaster, we're on the fall, we're down on the fall, we haven't come back up yet, the roller coaster's going to continue. There's more to come. What it is, I don't know. You're looking at the charts. That's great, Larry. That's great. But the next two, when it falls, you're going to say, wow, I didn't expect that. I mean, come on, Larry. The economy, what do we...
Well, come on, Herb. Herb, let's look at this. Financials, since the March bottom, up 13%. I mean, that's a pretty hefty move. Today, financials are up 4%. Home builders continue to like it. Retailers, tech continues to like it. Up until today or yesterday, materials liked it. I mean, we're about to cross 13,000, or we're about to march towards 14,000.
And then I got 3M out today, and 3M basically telling you the second half of the year is not going to be very good. Plus, you talk about the rising dollar, which has been helping all these multinationals. We've been talking about how great it is if the dollar goes back the other way, if interest rates rise. Larry, as my friend Doug Cass put it today, can you really have it both ways? The answer is no.
No, the answer is yes, because actually, Jerry Bowyer, what's happening is corporate rates are falling, even while government rates are rising. Now, I like that a lot. Government rates rising means, first of all, better growth. Second of all, people are less risk averse. Listen to this, the junk yield, the yield on so-called junk corporates has dropped almost 100 basis points just in the last month, from 10-20% to 9.25%. So I don't think Herb is right. I think these things are moving sensibly and contrasting properly. Why own governments if you see better economic growth down the road?
I mean, you know, owning governments is like stuffing it in the mattress, right? When you're terrified, that's a panic mode. The money's stuffed in the mattress. People are taking their money out of the mattress. It's about time. Some of us did it a lot earlier, but I'm glad everyone else is doing it now.
And Joe Lavorgna, look at this. Two-year note is now above the federal funds rate. I mean, in a sense, Joe, the two-year closed today at 239. That two-year is also up, I don't know, almost 100 basis points from its low a month ago. That is another sign of credit healing, Joe Lavorgna.
It's a sign of healing.
And actually is telling me the Fed need not ease one more time. Don't do it, boys.
They're going to cut. It's in the futures market. The Fed will follow the market. Rates will go to 2%. And then the two-year Treasury is telling us the Fed probably is done. But, Larry, you're right about the junk spread. But I think what you're failing to acknowledge is still what's happening with LIBOR. That's what got us into trouble in the first place. And there's still an incredible amount of funding stress in the money markets. I don't think that's going away. And I know you don't like this, but I don't think the Fed's done cutting yet, because I think there is still going to be a real weakness coming on the consumer side that will recover in the second half, but it's not going to be a very robust recovery.
They've done what they can, Joe. You see, they're starting to pay attention to the value of money, as per Don Luskin, as per Jerry Bowyer, as per me. They are rejecting your views, Joe. They're rejecting your advice.
I wouldn't say they've
out of hand.
Well,
Total
it depends,
rejection.
Larry, who
it's
you
not
think.
Personal,
Your guy,
Joe. It's
Plosser,
just business.
no, I know it's not personal. Plosser and Fisher, I think, reject what I'm saying, but I do think Bernanke, Cohen, and Mishkin have this view of looking at economic slack as driving the inflation process. And I would say if growth slows and that unemployment rate goes up, much to your dismay, the Fed will still probably cut rates.
Well, Don Luskin, I mean, Joe Lavorgna looks a bit pale today, I must say. I think he's a little bit shaken but not stirred on this front-page Wall Street Journal story. And you know, Don, another interesting thing is we may have seen a pickup in the factory sector in the month of March, because outside of the auto industry, which is cutting back like crazy, Ford profits, by the way, up because of the cutbacks. However, durable goods orders up outside of automobiles by 1.5%. We even saw some decent news on CapEx shipments in the month of March. Is it possible that that whole factory CapEx business investment is bottomed out in the late winter?
I think it is. In fact, I think that by and large, most of the macroeconomic data flow that we've been getting over the last month has either been downright good or at least surprising on the upside, but certainly has not been at recessionary levels except for the rare outlier. So I think what the Fed is going to have to start doing here is saying, whoa, we really front-loaded this, and the data has to keep getting really palpably worse for us to cut rates a lot more, because for goodness gracious, they're already 2.25%. Other than that 1% crazy low benchmark that Bernanke and Greenspan set in 2003 and 2004, 2.25 is already a rock-bottom interest rate, and there really is no further deterioration showing in the economy. There is improvement showing. The idea that, given all the inflation worries that they've got, that they're going to cut rates again from here, I think, frankly, is absurd.
I mean, Herb, you don't want to go back to that 1% Fed funds roller coaster, do you? That's what got us into trouble in the first place.
Well, look, we knew that cutting rates wasn't going to really spark a whole lot here. I was among those who were out here saying that a long time ago, as many were. But I think what's kind of silly, I sit here and I start chuckling because you guys are saying rates are going to go up, and that's going to be, now tell me how that's going to be great for housing. That's what I want to know, especially when all of those pay option arms that were done back in 07, early 07, and even before that, start recasting as the rates start rising a year from now. You're telling me that's going to be good for the economy?
I'm telling you
Herb, has cutting rates like crazy been good for housing?
It hasn't. So my point is,
so it doesn't matter. So it doesn't matter. Housing is just a planet in its own orbit. It's going to have to take care of itself. You cannot solve that problem with rates. And if you try to, you've got a big inflation problem.
Monetary management isn't the way to do it, guys. Listen, Herb, put your hand in your pocket. That money's going to be worth more as soon as the Fed starts tightening.
Hey, look,
that's the key to this.
As a saver, I am all in favor of higher rates. Don't get me wrong.